Welcome back, YouTube. So in this video, I'm going to cover what the SVB bankruptcy ultimately means, how this can affect the entire market, crypto, stocks, and kind of what happens next. I'm going to go over some important documents, and then I'm going to dive into this and break it down a little bit further to kind of give you a few scenarios on what can happen next. So pretty much just saying that this has happened primarily because of the Fed um, raising interest rates. And this is why regulators stepped in on Friday to kind of shut down the bank. Says the higher interest rate caused the market for initial public offerings to shut down for many startups and made private fundraising more costly for some Silicon Valley Bank's clients, right? Um, to fund the redemptions, pretty much their bonds, they were having to sell their bonds at a loss. They sold on Wednesday a $21 billion bond portfolio consisting most of US Treasuries. It was yielding 1.79%, far below the current 10-year Treasury yield of around 3.9%. This forced SVB to recognize a loss of around $1.8 billion, which it needed to fill through capital raise, right? So it announced on Thursday it would sell around 2.25 billion in common equity and preferred convertible stock to fill its funding hole. Its shares ending up trading on that day around down 60% as investors fretted that the deposit withdrawals may push it to raise even more capital. Stock sales collapse, all that kind of good stuff. So let's dive into ultimately what this means, right? So we know that this is the Federal Reserve pretty much raised rates at a very rapid pace, even more so than they initially believed when they were refusing to admit that we even had inflation to begin with. So SVB, as we know, a lot of banks, they operate on something called fractional reserve banking, which means that they don't keep the entire deposit in the bank when you make a deposit. So if you put $1,000 in, technically they only have to keep around $100 of that, and they can loan out the rest, invest the rest. When you go to the bank and buy a house, buy a car, all that kind of good stuff like that, you're essentially using other people's money, right? And what they also do is they'll take this opportunity to not only make interest on loaning out monies for things like homes and cars, but they'll also invest them in the market, not typically in risky investments, quote unquote, but in bonds and stuff, government bonds. And they typically get returns and everything works out smoothly as long as everybody does not come and offer to make withdrawals at the same time. They never have to come up with all the money at the same time because they never actually have everyone's money at the same time, right? That's the whole let me say ironic, but that's typically how this thing works here. So what happened is you'll see, go down here, you'll see they had a $21 billion bond for 1.79%. So pretty much that only works out if you're able to hold to maturity. You guys know that if you, it's kind of like how a CD works. I believe more people are familiar with CDs than bonds. If you invest in a CD, you have something called a term. And if you hold to maturity, you're guaranteed to get X amount of return. But if you don't, you things like penalizations, and then of course you don't get the return. So it's possible that you can even redeem a, a bond certificate, some stuff like that, early at a loss, even from what you put it in. Even though you're needing to raise the capital even better, it's kind of like trying to get a loan at a pawn shop or something like that. You're never going to get what it's actually worth, and there has to be that spread in there. So you're going to actually be when you're, I'm not going to say desperate, but when you're going in there to try and get money, you're not going to get anywhere near what you should, but you are raising some form of capital, but you're still taking a loss. And this is kind of what happens. They're saying that they needed 1.8 billion, and they were like, okay, well, we're going to sell 2.25 billion of our stocks. The issue with that is when you start having banks saying that, okay, hey, well, we're having some liquidity issues, right? And we're going to sell $2.25 billion. This kind of triggers a panic of, insolvency. And when that happens, people typically start, they don't want to invest with you. And this is why you see that the share count, not the share count, the share price dropped by 60%. And this triggers a domino effect of panic, because if the share is collapsing, they're having issues raising money and stuff like that, or they can't raise the money. What does that tell the people who have their money in the bank? That says we need to get out. and that triggers a run on the bank and people making additional deposits. Now, if you couple the fact that A, you needed the money to begin with, and B, your share lost 60%, and then C, people are withdrawing records amount of cash, that kind of leaves you in a no way possible that you're going to get out of this situation. So this is kind of why you had the regulator step in on Friday and say, hey, we're kind of going to take things over, FDIC insurance, all that kind of good stuff. And hopefully this can kind of breeze over. But this isn't going to breeze over. Let's kind of take a deeper dive into this. The term that they had was for 4 years, around 3.6%, 3.6 years. So these loans were taken out in 2021, 2022. They were nowhere near maturity on any of those bonds. So that is going to be a huge hit there at 1.79%. They were not going to make much money anyway, because again, right now you can take those same loans out for about double what they were placed into. So they were not anywhere near market value. And another thing that you want to look at is Silicon Valley Bank is not like a Wells Fargo or Chase, Bank of America, where like you and I kind of scroll in, open up an account. This is for venture capitals, for startups. This is why you see a lot of these articles, and it's really true, that only about 2.7% of the actual deposits in that account would actually fall under the FDIC insurance. And if you're not familiar with that, that's pretty much a government insurance policy on your capitals that was started during the Great Depression, during those bank runs, to say that, hey, we're going to guarantee you at least 250,000. 97.3% of those accounts in SVB are above $250,000. So imagine this with me relatively quickly. Imagine if you had $30 million in an account and it went poof, and the government said, hey, we got 250K for you. And this is not just like you and I, this is not like a savings account or a checking account. These are businesses. Imagine paying taxes, making payroll, expansions, equipment, maintenance, and all that kind of stuff like that. $250,000 for a company, for a $30 million company, $20 million companies. That's a spit in the face. This is going to have a domino effect into next week, probably for weeks to come. We're going to see just how big this actually gets. The another thing is the question that arises: are we going to hear the whole too big to fail thing again? Are we going to get some government bailouts? Is Biden and the administration going to step in and say, "Hey, this isn't the right time"? Are we going to get those bailouts coming in and saying that, okay, well, we have to bail out these businesses because this can trigger a domino effect? And we're going to get into what that domino effect is in a moment. Is Powell now going to retract his statements and not put a further squeeze on this by raising rates even more? Because if Powell comes out and says, hey, look, we're still going to 5.25, and you have a domino set of banks and stuff like that who are tight on cash and have this pull of cash from these institutions, that can further cause pain. These are some questions that we don't have the answers to right now, and that we probably won't have until next week when we start hearing Powell say, his conversations, or see if he's going to pivot, because these are all things that can further magnify this pain or this domino effect here. Another thing is that if we look at the next few weeks and we say that how can this cause a domino effect in businesses, right? So if SVB is for venture capitalists, for startups and stuff like that, I'm not saying that they have all of their money in there, but if you take an account down from millions of dollars to 250,000 in the short term, because even if they were to get more, or to see if SVB is actually solvent, or if they can get capital, that's going to take time, months, maybe even years. What are they going to do in the meantime? If the rates are high, because the feds are they going to borrow money at record rates, or are they going to start dumping their other assets, i.e., these are companies, institutions? Are they going to start dumping stocks holdings? Are they going to start dumping crypto holdings and stuff like that? Are we going to see a massive domino effect here? This is the second largest collapse since 2008. Are we going to see a similar collapse here, where this is causing a domino effect into the market, to crypto, stocks, all that kind of good stuff, where they're doing these massive sell-offs because basically they're forced to have liquidity? You can't run a $30 million business with 250K in the account. What is that, like less than a month of payroll? Like you're going to have to get liquidity from somewhere. So um, these are some of the questions that we have and some of the things that's going to have to be answered really quickly on Monday and Tuesday. And this is why things can get really ugly on Monday and Tuesday, because, and this is why we're saying that this can cause a domino effect, because if they do have money in other banks and they're saying, okay, we need access to this money, and they have them in other banks, if they start pulling the money, because again, these are bunches of companies, they say, okay, well, we need this money to make payroll. So if this is going to be held at another bank, what if X company says, okay, well, we need our 5 million out of this bank since SVB doesn't have it, and B company says, okay, well, we need 2 million out of this bank, and then now you have this domino effect where this can turn literally just a recreation of 2008, really. The best thing that to do in these situations are most people, for people, typically this doesn't apply unless you have a lot of money. Most people don't have $250,000 in an account. If you are one of the people who are fortunate enough to have that kind of money, it is certainly best to make sure that your accounts are spread out so that you can at least get multiple 250K. So for example, 250K in Bank of America, 250K in Wells Fargo, 250K in Chase. So that way, instead of having 750K in Bank of America and getting chopped down to 250, at least you can get 750K in 3 different banks. But if this is one of the reasons why you don't hold that kind of cash, and you can ride the tides a little better in investments, because these things are rare, but they do happen where these runs occur, and it puts a strain on investing. So you have to kind of split up your money, and defense is going to be the best protection versus trying to play offense afterwards and hoping for the best, and trying to pretty much dealing with um, what's the proper term for it, if you're dealing with being reactive instead of proactive, right? And this is not a position anyone wants to be in. This is more so businesses, and I believe a lot of stocks, crypto, and maybe even us as common people can be collateral damage. But this is pretty much what happens when SVB pretty much made a bad bet, saying that the Feds weren't going to raise rates the way that they did, and they invested too much money into that bet, and they had too little liquidity afterwards to kind of hedge themselves if they were wrong. And this is kind of what happens when you take an all-in approach and there's uncertainty in the market, because if they pivot, it blows up. So outside of that, when it comes down to opportunities and stuff, as far as for taking advantage of this in the market, whether that be puts or shorts or stuff like that, I know a lot of people are going to be engaging in those very rapidly next week. Do be careful, especially with leverage, when you're taking these negative marks, but there certainly will be an opportunity to make money there. And for those long-term investors, whether that's your blue chips or cryptos and stuff like that, this is going to provide some great opportunities for entry. So if you are long, or you're looking to do quick flips and stuff like that in the market, just do be wise as far as for leverage. But overall, this is going to be a great opportunity no matter how you're playing the game, whether that's to increase your position or do those swings. But again, just be careful with trying to time the bottom and stuff like that, because no one knows, and we don't know or have enough information to know how deep these roots actually go. We're going to find this out day by day as we go into next week. And of course, I'll be covering this and relaying information to you as I find it out, and we'll kind of go from there and come up with some ideas and stuff for all of us. So with that being said, like the video, share it, subscribe, and I will see you guys in the next one.